Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in. Today, we are happy to introduce Matt Curtolo, a seasoned LP who you may be following already. More than 2 decades ago, Matt began his alternatives journey at Hamilton Lane. He then went on to lead private equity at a large outsourced CIO firm and then co-managed MetLife's alternative investments portfolio. Most recently, he built out the investment capabilities at fintech startup Allocate. And we're speaking with Matt today about which strategies for allocating work for bigger institutional investors versus the growing high net worth retail investor class, and his lessons learned from working as an allocator on all shapes and sizes and managing hundreds of GP relationships over the years. Thanks, Matt. You've invested on behalf of some of the largest limited partners in the world, and that's across alternative assets. So could we start out by just talking about sort of the role venture plays in relation to other alternatives for these really big institutional investors?
Yeah, it's, I think when you think about an alternatives portfolio, right, it can cover a lot of different areas. I think traditionally with larger institutions, the places where you can park the most capital get the most attention. So places like credit, buyout, infrastructure, places where large checks can kind of do their work, end up being the lion's share of an allocation. And that's a generalization. Every institution is a little bit different. But venture is usually the smallest piece of the pie for large institutions. And obviously, when we talk about the endowment and foundation world, that's a little bit different. It's a different pool of capital. So we can segment LPs into a lot of different subsegments. But we can just say the bigger you get, the more important the efficiency of capital is. And oftentimes VC, which requires smaller checks, the fund sizes are a little bit smaller. So that ends up being a smaller portion of the pie. So I think the piece of that becomes a little bit of a constraint is the bigger you get, the larger checks you have to write. The universe of VCs that you can invest with also gets smaller. So you start thinking about portfolio construction. Like, can I write a $10 million check when I have a $3 or $4 or $5 billion annual plan? So thinking about moving the needle and thinking about, again, not just efficiency of capital, but efficiency of time. That's also something to consider as you put venture into the portfolio. Is it meaningful enough to spend as much time? So I think you have some of these plans who will outsource it entirely. Maybe you go to a fund of funds. Maybe you use, kind of the hub and spoke model. So you may have 1 or 2 large relationships that then you can maybe add on to with some smaller specialist type funds. You really want to make sure, and I think most of these organizations are cognizant that the dollars have to be meaningful to make it worth the while. Now, on the flip side, I've long been a proponent of technology as a component of a portfolio. Obviously, venture is the best expression of technology and innovation. It's the lens into the future. So I think if an institution is not paying attention to it, is not investing in it, is not active in that space, whether it be directly, indirectly through fund of funds, creatively through other structures that may not even be available to all investors, that you definitely have a blind spot then, because you're either seeing things that are multiple years ahead that you're going to see reflect in the rest of your portfolio, or in other cases, you may just be missing, a big potential source of alpha, as we see in the public markets over the last several years.
Matt, you mentioned how the different LPs can be segmented off based on how big they are and how that has an impact on what type of venture allocation they can make. Is there anything from your days as an allocator or in the outsourced CIO role where you feel that VCs don't have a good understanding about their, first or second most important customer, the allocator?
I think it's a good question, because I think that is something that we talk about a lot, is like, where do you fit overall in the ecosystem, right? Your customer, right? You can't be in business without folks who are willing to provide you capital to go execute that strategy. I think that's something we always remind folks. It's a fortunate position to be in. You are getting trust and confidence from investors and getting capital to do that. I think just understanding who are the right people? Where's the right lane and right path to go down for the VCs? This whole know your customer concept resonates throughout the industry. So it's making sure you spend the time to listen to who that customer is, understand what their goals are. I always say this is a long journey, time and patience. And your timeline as a VC is likely going to be different than the allocator, than the LP. So making sure that you're going to have to bend a lot of different ways and coalesce to a lot of different circumstances that might be happening. The snap your fingers and have it happen is not something that really happens, particularly at the larger end of the spectrum. Those larger institutions have, I would say, more process in place for good reason, but that does elongate the process. And knowing that going in, I think, is super critical. And knowing when to take no for an answer. Right?
Yeah.
I don't think that's something that a lot of people have a great handle on. There's the idea of being persistent in a respectful way, but also valuing your own time. Right?
Yeah.
You can't convert everybody, no matter how hard you try.
Matt, I'm gonna throw a curveball at you, but
Yeah.
it's kind of on this on this subject. From our various conversations on air, off air, um, allocators as well as VCs, friends of ours, have spoken about kind of the difficulties of working with kind of the third parties within our ecosystem, right? Whether they're consulting firms or outsourced CIOs or a combination of both. Um, and then you also mentioned that there's more technology coming, right, to make it so there's more information provided.
Mm-hmm.
What's the case for that type of allocator, that role in the allocator space today? And how do you think it's changed over time in your career?
Yeah, I think it's been a few decades. So if I go back to the early days, it was, the universe was a lot smaller, so coverage was a little bit easier. I think that the fundamentals of how you source, how you do diligence, how you ultimately monitor managers once you've made an investment, the core of that hasn't changed. The implementation of that, I think that your point about how many layers do you have to go through, there is a place in the market. Consultants serve a really important role within a lot of structures. But you also want to make sure that the flow through of that information is happening in both an efficient and a transparent way. So that's where I think, as time has passed, technology, whether it be, I now have access to a portal. I mean, this sounds like, we talk about like the iPhone's only, 15 years old, but the beginning of my career, it was still all PDFs and documents. We had file folders and file rooms, and that's how you entered information into a system to be able to look at that portfolio. So an innovation like that, where everything is digitized, now we have things where you're able to scrape that data, get that into a system without any human intervention. So that's just an efficiency gain over the years. I think that helps the end LP. If you talk about layers in between, that's going to be a place where the LP is more informed, can make better decisions, and can think more independently, and probably tease out more insights. I think that's a pretty basic example of where technology's being inserted across the value chain. But even the models that we used to run in Excel, that you'd have to press a button and wait a few minutes for everything to populate, being able to have higher order analytics, doing things that are derivative calculations and things like that in a system that understands our asset class. For many years, it was just trying to break legacy systems into, or conform them into working for what was necessary in private assets. So now we have purpose-built systems, which I think give an allocator, I think, and a GP a lot more tools in the toolkit.
We also hear that a lot of, even family offices, they're much more interested in bringing on somebody who maybe was an early analyst at a VC fund, and they're looking to do directs because that's where they see alpha, rather than working with an outsourced CIO. Can you help give some perspective on where where you come to the table versus trying to do this yourself in-house?
I think the first question that every allocator or every institution that's looking to allocate needs to ask. Having worked at a place like Allocate, where I was most recently, where we were serving as the conduit for the high net worth individual for effectively the institutional retail market, that's a group that probably can't afford to hire their own staff to be able to execute this. So you use a platform, you use the best fit resources that are available. So I think one is how much capital you're going to deploy. How much control do you want over that? Do you want somebody in-house who can implement a very specific strategy? In which case, there's the trade-off between cost, time, and the value of that person. But I do think, again, back to the point of size tends to dictate what type of offerings are available to you. So I think, having worked at Hurdle Callahan, the outsourced CIO, many of our clients were small and mid-sized institutions. That might be anywhere from $50 million of assets to $1 billion. But the consistent theme there is it's still not that big to have a full-time staff focused on this. Yeah. So you can pick a number of where does it make sense to start bringing people internally. And I think it does go back to those key themes of how much time are you going to spend on it? How many dollars are you going to deploy? And is there a particular strategy that you feel like only you can reflect through direct implementation?
Has the recent kind of performance that we've kind of issues and just the kind of cold market that we've had in venture in 2023 change any of your thinking on the asset class going forward?
I would say yes and no, right? I think entry price is the only thing that you can't change, right? Once you're in a company, what you paid for it is what you paid for it. Everything else, particularly when you think about an early stage company, it's probably going to change along the way. So yes, we're in a more favorable pricing environment from an entry perspective. It's not universal. And I don't think it's cheap by relative standards, but it's certainly more attractive. So I think folks still need to exercise discipline. So yes, broader market favorability as valuations have come down and entry pricing has come down. But I'd say no to the fact that venture is not really something you should think about in a tactical allocation. As an allocator, when we think about early stage, like it's 5 to 10 years for these companies to mature and exit. And like I said, they're going to pivot or evolve during that period. So trying to time, honestly, any private market is a fool's errand. But venture, I think, is particularly silly when you think about that. So as an LP, I have to map the market. I have to do my due diligence. I have to ultimately make a commitment that can span several months or even quarters. And then the manager themselves is going to spend 2, 3, 4 years finding and investing in the new companies, then making follow-on decisions, helping those companies scale if everything goes right to an exit. And my sense is a lot of things are going to happen in that time period on the broader market that are not necessarily going to be things that you have control over to be able to impact. So I'd kind of take it back to, you don't want to try to time this market. It's still fundamentally a bottoms-up manager selection game. And that's not to say certain vintages aren't going to be better than others. And I'd argue now the entry point's better than it was in 2021, for example. But if you just took $1 today and blindly allocated it to any manager, I don't think that's going to be a recipe for success. So the market is more favorable now, but the manager selection and finding folks who have exhibited discipline across a lot of those cycles, I think is what's really going to be the driver of outperformance from this vintage.
There's quite a bit of buzz right now around a recent Carta report where people are sort of thinking about timing the market. How much do you leverage third-party reports like PitchBook and Carta for when measuring performance? Are you nervous about any of this new data?
It's, performance is one of those things that's always been the hardest to truly measure. I remember my first role at Hamilton Lane in 2004. We were trying to develop what was an appropriate benchmark at the time. And that is still ongoing. So I don't think there's a holy grail yet of like, here's a number that everything should map back to. Here's a data point that we all anchor to. all of the universes out there that collect data have their own flaws, and I think they're all incomplete in terms of truly covering the whole market. So I always say they're all good data points, but take them with a grain of salt. Use them with caution. And I think the other thing, and Alexa, you mentioned the Carta report that came out, making sure there's context around these data points. I think Carta has a unique lens into the market, given the type of transparent data that they're able to collect on a company level and at a fund level. So that's something that's valuable as an augmentation of what exists out there. You know, the PitchBooks, the Cambridges, the Prequins of the world who have been around for decades. But something like that chart, that particular chart that came out was a chart about DPI for early stage companies. And it created a lot of buzz because I think people took both sides of the argument. And the reality is that's not right or wrong. It's your assessment of what that data point means to you. I would make the argument that as an early stage investor, if you've underwritten meaningful DPI by year 4 or year 5, you've probably been a little bit too optimistic. And maybe folks who are underwriting in 2020 and 21 had those rose-colored glasses on. But I do think that's a data point that is interesting to look at, interesting to talk about, but in isolation is not something that should dictate your investment strategy or how good or bad something is. It's one piece in the mosaic. But, you know, about performance, I think we talk about these universe comparisons and things like that. There was a report, I want to say maybe 5 or 6 years ago, that said 75% of funds could label themselves as top quartile, depending on which universe they used. So it's pick a metric, pick a universe, get a little wiggle room with vintage years. So top quartile, people promote relative performance and expect that from an allocator's lens to be the guiding light for what's out there. It comes back to you as an investor in an institution. What's your goal? And that's the thing you need to measure against and manage to. So if it's an absolute return, if it's a relative return to the public markets, if it's a relative return to a composite that comes from one of these universe providers, that's what matters the most. I think we throw out a lot of arbitrary terms that people take as gospel without looking at the context. So I think it's certainly more prevalent as more and more folks are active on social media with comments on all sides of the argument. But keeping it insular, what is the most important thing to you as an organization and investor, and really managing towards that without letting the noise kind of impact a lot of that decision, I think is the way to think about performance.
Freaking hilarious. 100% of VCs are in the top quartile.
It sounds like an Onion article. It actually reminded me of, I was talking to a allocator out here in San Francisco who will remain nameless, and is kind of bearish on venture, although they do someone else on the team works on it. And he was saying that with the growth of how many funds there are, how impressive is top decile anymore if there are 10,000 funds. So it really goes to not using the kind of the same frameworks that we've used in the past, but like, what is your, as a firm, what's your personal goal? Like, what's the return mark that you're looking to hit?
Ernest, it's funny. I'll add something to that, because looking at an analysis of the number of funds that are captured by these major universe providers, and then you look at both anecdotally and factually the funds that have had a closing, I don't think there's a major universe, probably a little dated, that covers more than 20, 25% of the market. So even though the top decile that's being reflected in some of those universes, maybe it's a number, but you're probably excluding more than half of the market. So is that a real reflection of what the relative performance are? You know, you get a lot of these, I see a lot of decks where folks are showing numbers that are likely not being captured. They're too small, don't have institutional backing, or whatever it might be. So is that again, a fair assessment of how your portfolio or how the fund managers are performing?
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have industry expert and sponsor Paige Gardner, territory manager of Texas at Camber Road. Camber is the most cost-effective and flexible leasing company for venture-backed businesses. Thank you, Paige, for partnering on the show.
Thanks for having me. Happy to be here.
Absolutely. Camber Road offers equipment financing. So can you help lay out when we have a lot of VCs listening. They've got portfolios filled with founders. When should they all be considering leasing versus traditional debt?
Anytime, really. I think for us, I always want to start the conversation earlier rather than later. But when you think about leasing versus venture debt in particular, we're big believers in diversifying. We think that both are really important and see ourselves as a complement to venture debt and complement to venture capital. We think venture debt is a great product, and we work really closely with venture debt providers, which that can be used for a multitude of different things. I think the main differentiator between leasing and venture debt is really our focus, and that being strictly on CapEx and FF&E.
Mm-hmm. And I think we VCs appreciate it because nobody's leveling us in the with senior debt.
Right.
What are some examples when you say equipment of what founders are working with you to finance?
Yeah. So we're totally industry agnostic, which means we finance all different types of equipment and tech, everything from heavy duty machinery, manufacturing equipment to laptops and office furniture. It's really any physical asset you can dream of. We've likely looked at and financed. Some things that don't typically come to mind when people think about leasing necessarily may be, we also do really custom and bespoke assets, first of its kind, cutting edge technology.
Cool.
So compared to some other lenders, we're less focused on the hardware itself, more on the company and the scalability of the opportunity.
Mm-hmm. Interesting. No, that's very helpful. And who's a good fit for financing? What are you looking for when you're assessing them?
We're looking for fast-growing, primarily venture-backed companies that we think we can build a long-term partnership with. What really excites me is working with companies that I know we can scale with over time and do a lot more and grow alongside them. So we use our own capital too, which that gives us quite a bit of autonomy over deciding who we work with, what that looks like. But I think the one commonality among all of our customers, and certainly our best customers, are those that believe their equity is extremely valuable. And they understand that by leveraging a partner like Camber Road, they can extend their runway and get to that next fundraise in a stronger fashion and ultimately hang on to more equity.
And what do terms look like? Like maybe you can't give a typical term sheet, but what's an example of what you might expect?
Yeah. 18 to 36 months in length is typically the term length that we see. It's a true lease, which means we maintain ownership of that equipment. Our customers lease it from us and pay for the use of it on a monthly basis. There are no covenants, no blanket liens on the business, no personal guarantees, no warrants, things that our customers really find a lot of value in. And then at the end of that initial lease term, our customers have 3 different options. So they can, one, return the equipment, they can buy it from us, or they can continue leasing it.
Well, this has been super helpful. Any industries particularly catching your eye right now, as long as I have you, Paige?
Anything that has or needs hardware to scale.
Okay.
So we're seeing a lot of hardware as a service, robotics as a service, whether it's like those things are tracking devices, point of sale systems, those opportunities where we can help our customers bring in more customers than they would be able to otherwise while still preserving cash is really exciting to me. So industry-wise, nothing super specific, but the commonality being there's that hardware component that they need to grow, and we can help be that partner.
Definitely some portfolio companies of mine coming to mind. I mean, this is very helpful.
Awesome.
Thanks, Paige.
Thanks so much, Alexa.
Thank you for being on the show. If any of you listening have portfolio companies interested in buying stuff, whether that's heavy equipment or laptops, you can reach out to Camber Road's managing partner, Steve Aronson, ARONSON at camberroad.com for equipment financing. And now back to our LP interview.
One group of the kind of allocator stack that we haven't really dug into much on the podcast yet is allocators that come from the kind of insurance world, insurance companies. And so we wanted to jump into like your experience a little bit at MetLife, and interested to hear about how that business, like the overall umbrella business, impacted your strategy as allocating into venture.
Yeah. So MetLife obviously is a 150-year-old life insurer, Fortune 50 company. The program there is obviously managing the general account for the insurance company, as well as its affiliates. So there is really the goal of matching assets and liabilities and making sure that the core business is structured. So you can imagine equities in general are a very small portion of the overall book, because you think about stable, you think about income producing, you think about a lot of those components of the asset stack. So equities was always a very small portion. And then alternatives was also, again, a subset of that. So I would think, given the size of the pool for a lot of life insurers, and then I'll talk about MetLife more specifically, something like venture is either not pursued at all because you can't make it work in the dollars and cents because the pool is so large, or it's done really on a selective basis.
Mm-hmm.
At MetLife, I think we took an approach that the company had been investing in alternatives for over 30 years when I joined in 2019, and they had been investing in venture since 1988. So it was really an active program. I'm not sure it was going one way or the other. They lived through the dot-com boom and bust, and then really made a strong push to get back into venture right around the global financial crisis. So the value of the dollars coming from an organization like that, a large stable check that could go into firms that are top tier, all the brand names that we would know. You wouldn't think of a firm like MetLife or a life insurer as a cornerstone LP in these top tier venture firms. But in 2010, 2011, a lot of that exposure was built up, being able to provide some ballast, as a lot of investors, particularly in the ENF space, couldn't go back to these funds. So we were able to build up a program starting at that point, really with high quality brands, and then being able to complement that across the entirety of the stack, whether it be with specialists in a sector or a region, or maybe some later stage folks. I would say the arrow in our quiver that was most impactful at MetLife, and I know this is consistent with a lot of other large firms, but we had a fantastic innovation office within MetLife. So when you think of corporate VC, it takes a lot of different shapes and sizes, but MetLife's investment office was folks who understood both sides of the wall. So their primary goal was to understand all the needs of the insurance company. And you might think, okay, so this is going to be around insurance products, insurtech, things like that. Mm-hmm. No, it's really all the needs of a Fortune 50 company, whether that be HR, or whether that be any kind of implementation across all the business systems. And then working with our team on the alternative side to get connected directly with the business officers within each of these venture firms, so they can basically have an idea share. And what's better than an early stage company having a pilot with someone like MetLife? So that was a way that we were able to really elevate our status with a lot of these GPs. It was one of those things where it wouldn't necessarily be something that people would know about or take a look at the organization and say, wow, this is what MetLife brings to the table. But the compliments that we got from that team, and a huge shout out to that group, that was really an amplifier of what we were able to do. And as access was getting tighter and constrained, it was maybe a tiebreaker in a lot of situations for GPs to open up more allocation for us.
When access is constrained, there's these windows. It seems like we're in one where you can get into a fund you may not have been able to get into a couple of years ago. Do you get to keep your seat?
It is a multi-layer answer to that question, Alexa, because I think the organizations, going back to the idea that it's not tactical and thinking about, okay, maybe I'm going to dial up or down based on what the prevailing macro conditions are or what the rest of the portfolio is doing. this sole denominator effect that sort of comes and goes over many different cycles is, a set of handcuffs for a lot of allocators. So that does open up allocation for newer entrants. Obviously, most GPs would love to upsize the existing folks to fill those holes. But if you're a top tier firm and you have a list of folks who have been, you've been either cultivating the relationship with or have been banging on the door, it's an interesting proposition to be able to let some of those folks in. Mm-hmm. I would say we're seeing a little bit more turnover in those seats too, partly because we always say in the LP world, it's musical chairs. Like there's a group of folks who are moving seats and taking different roles. So does the relationship live with the individual, with the organization? How are you able to continue to compound those relationships with a new or existing organization? But I do think with the turnover of folks, and we saw a period of really rapid growth by GPs. So they tapped markets like the retail market and looked at other avenues to build up LPs. So I think the coveted seat of I've been here since the beginning and I'm going to continue to do this, it should be safe. But I do think in a lot of cases, GPs aren't going to kick you out, but they are going to continue to expand and look for different avenues to raise capital.
And one great avenue that, or new avenue that we've been able to see is accessing new pools of capital. And so we've seen the rise of a lot more high net worth individuals and RIAs. Would love to hear your perspective on like the opportunity there, and come from your experience at Allocate, but other offerings that group of or that pool of capital is getting to enter into venture as well.
Yeah, I think that's the most exciting part of this market today. If you think about that period, call it anywhere from the mid 2010s to early 2020s, as funds continue to expand, Ernest, you alluded to the number of funds being raised, the dollars that were coming from traditional institutions where I had worked my whole career, there was a max, right? You couldn't keep doubling and tripling and adding new names. And there weren't new endowments or new pension funds popping up with any regularity, if at all. So GPs had to start thinking about other avenues. So private banks had been around for a long time. That had been a channel that a lot of folks had used. But really this concept of democratization and bringing venture to more folks, I do think is the next wave. So firms like Allocate, where I spent time at helping build out that offering, the idea is bringing what was only accessible to the big institutions to more folks. There are friction points and structural constraints that you have to work around to make that happen. Right? If you're an accredited investor, or if you're a small ticket investor, going directly to a top tier firm and offering them 50 or 100K is, it's just not how the system works. Now, you could argue if it should or shouldn't, but that's just the rules of the game. So building constructs to be able to make that easier, whether that be with feeder funds, whether that be with, smaller fund of funds where those minimums can be a lot lower. So I think there's a lot of avenues to do that. We've seen a rise of evergreen funds. I think those have a lot of appeal to bring in the average investor into the asset class. So that opportunity set, you can take a look at any of the research. It's, tens of trillions of dollars that could be allocated to alternatives and broadly. And then if you think about the venture opportunity set, that's going to be sort of this emerging LP who probably hasn't done it before, has the desire and appetite to do it, and now also has a means to be able to execute on some of those ideas that they're trying to bring forward in their portfolios.
We talked a little bit about what a balanced portfolio looks like at MetLife, the sliver that venture makes up. Similarly, your clients, when you worked as an outsourced CIO at really big institutions, for these high net worth individuals, you're dealing with so much less cash. What's the strategy for venture that actually makes sense for you?
Yeah, I think each situation, each fact pattern is going to be different for each investor. So I would avoid painting with a broad brush, but
Yeah.
one of the things we always say with these types of investors who haven't done it before, don't shoot all the bullets in the gun. Kind of be very thoughtful and ease into it. So your first commitment, if you think, hey, over the next 5 years, I have $1 million to invest, don't write $1 million check this vintage year, right? I mean, that's probably not the best way to get what would look like an institutional type portfolio. Being opportunistic is great, and recognizing that illiquidity is more acute oftentimes for the high net worth investor. So making sure that you have enough coverage to make sure you can make those capital calls. It sounds simple, but also making sure you understand the dynamics of what a drawdown vehicle looks like and what type of exposure you're going to get and what a J curve looks like. I can tell you across multiple organizations that I've worked, when you get those first or second statements and you see a negative 80% return, the phone calls start coming in. So I think making sure you're educated to the point where you know what you're getting into before you make that first investment is critical. And that's just fundamentals. I think you can find that all online. A lot of firms do some really good education pieces to just kind of get folks up the curve. And then sizing it in a way that's comfortable for you. We talked about with big institutions, you want it to be meaningful. I'd say with the high net worth individual, think of it as, if you think your standard check is going to be X, think of X divided by 2. Think of about half that as your first step in, just so you can get comfortable with this, just so you can kind of understand the landscape and feel confident that this is going to make sense for you longer term. The biggest challenge is protecting people from themselves, right? I think people are used to investing in public markets where sentiment drives a lot of what's happening. Venture's not a set it and forget it, but for the most part, after you make that commitment, you're not going to get a ton of feedback. Quarterly valuations, financial statements, maybe you hear from them 4 times a year. Not a lot changes in those early years, other than new names added to the portfolio. So you have to make sure you're in the mindset of, I have a long-term view. I have the capital that I want to dedicate to this. I understand what it means to my overall portfolio. I should be able to access something that's going to provide some alpha over the other opportunities that I have available. But my number one is just making sure you know what you're getting into before you write that first check.
Yeah. We have plenty of LPs who come on this show and they talk about indexing venture, that they need to capture, just statistically, it's a game of chance, and they just need to capture X% of the unicorn. So they need X number of managers. Is this like online gambling, where the professional online gambler is playing 24/7 and you log in because your favorite quarterback is playing today? Do you have any chance if you are only shooting a few times on goal here? Should everybody just run the other way under a certain net worth?
It's a good argument to make. I think you could definitely make the case for, if you can't do it right, don't do it at all. I would definitely advocate for that, but right, I think, takes a lot of different pieces of that. The indexing model, I think, in venture is impossible, right? You can't ever buy the whole market. And that's why it's always going to be an active management game, but shots on goal is meaningful, right? You do need to have enough hits. The power law is real when you look at all the data. But there are also other ways to make money in venture. I think early stage definitely has those characteristics. But going back to setting your own goals and targets. So am I doing this to get exposure to different types of assets, earlier assets? The public markets are becoming more and more squeezed in terms of just the number of companies that are out there. Do I want to introduce a new pool of companies into my portfolio, potentially getting more compounding? So I think it's less. I have to reprogram my brain a little bit, thinking it's just about picking the best managers in each of these. It's picking managers and picking funds, investments that are going to meet your criteria, versus just trying to be in that upper echelon. Hopefully, you'll be able to achieve all of that, but in some cases, they don't overlap, right? Maybe there's something you're trying to accomplish with this allocation that goes beyond just trying to capture, a market level return for venture, which I would argue, if you look at the median returns over a long period of time, they're not that great. I mean, they're
Yeah.
good, but it is still about that manager selection, being able to pick the right firms and funds. So making sure that you do have some sensibility of what you're seeing, why you're seeing it is another lens to put on top of that. I can't emphasize enough that when we look at portfolios that have been created, one of the hats I wear today is looking at family office portfolios that have been constructed over the last several years. And, that there are decisions that were made that I don't think were in the context of a long-term program. They were more opportunistic and tactical. So trying to unwind some of that and making sure you understand what you're trying to accomplish with those dollars, I think becomes a lot more relevant when we talk about individual portfolios. Not that it's not important for institutions, but I think it's a little bit more commonplace where you have a strategic plan that you're executing against.
Yeah.
Matt, you've mentioned a number of times that this is a bottoms up, like fund manager picking business, right?
Mm-hmm.
Like, well, it's one thing looking at the median, but like people don't come here, people don't go to Vegas to get the average, of what they're trying to win big money, right? And so do you have any, less popular beliefs or hot takes on what makes a great manager?
I don't know if they'd be hot takes, but I definitely think there is. I have a fundamental view. Being contrarian is going to be to your benefit over the long term. The herd mentality, I think, is prevalent both on the LP side and the GP side. You see the shiny new thing, everybody runs towards it. I do think that the Gretzky quote of "skate where the puck is going, not where it is" something that a lot of people need to think about. So being able to invest in things that are a little bit out of favor and having your own personal conviction around that. I know the flip side of it is we saw a lot of firms pivot from crypto blockchain to AI over the course of a couple months, couple quarters. I come back to the things like authenticity. We always talk about this idea of GP thesis fit. Like, are you the right people to be doing the right thing? You overlay the market on that. Like, maybe it's not good or bad, but I believe those two pieces, if you have a particular specialty and area of expertise, maybe it's not going to transcend market, but it could end up trumping the, what's going to happen in some of those spaces. So kind of being willing to be contrarian. I'm spending a lot of time talking to folks focused in the consumer space, D2C, whether it be things like that, where I think by and large, most folks have, I won't say walked away from that, but have focused a lot more on B2B, focused a lot more on AI and SaaS and things like that. Not to say those aren't good areas and areas where I think they're going to be great investments, but the consumer makes up 70% of the GDP. There are a lot of different pockets within that space in particular that I think will be really good opportunities. And because they're a little bit unloved or overlooked, the valuations might be better. The exit opportunities, if you look over the course of time, have always been there in a certain range. So that's one thing I would say for a lot of GPs is be true to yourself and what you're doing rather than try to chase where the dollars are in the market. It seems simple, but I think a lot of people fall prey to the human instinct of kind of running where that is.
If it's trendy, you're already too late. Yes.
Very true.
And so it sounds like you are definitely actively taking pitches from managers. Who do you want to hear from?
Yeah, I mean, so given the background and history I've had, I've kind of worn a lot of different hats at different allocators, have looked at funds across all strategies. I have a number of engagements right now where I'm talking and helping a lot of emerging GPs kind of put together what would be a good go-to-market strategy in terms of what their ideas are, getting their thesis on paper, really imparting what I've learned sitting on the other side of the table of how do you deliver a clear message. Providing candid feedback, interestingly enough, is a sought after skill set here, where I think a lot of people get either get ghosted, get a no thanks, but very rarely get a lot of candid feedback. So if you're an emerging GP, I'd be more than happy to help you on that journey, and then as a personal investor as well.
Well, Matt, we want to thank you so much for taking our time and just providing your vast insights from your vast experience as an allocator. Thanks for being on Swimming with Allocators.
Thanks a lot, guys. This was great.
See you later, Allocator.
After Portfolio Tile, investing with a smile.